For the better part of the last economic cycle, Texas was treated as the exception to every rule in American real estate. While coastal markets struggled with affordability ceilings and regulatory overreach, Texas offered the trifecta: no state income tax, explosive job growth, and a business-friendly regulatory environment. Capital poured in from California, New York, and Illinois at a pace that broke migration records. Builders couldn't keep up. Prices surged. And a narrative took hold that became almost religious in its certainty: Texas real estate only goes up. But here is something most people completely overlook. Every single real estate bubble in American history was preceded by a narrative of invincibility. In 2006, it was housing never goes down nationally. In 2000, it was the internet changes everything. Today, in the current cycle, the Texas equivalent is migration will never stop. And the data emerging right now is beginning to challenge that assumption in ways that should concern every investor, homeowner, and developer with exposure to the Lone Star State. What we are witnessing is not a dramatic crash, not yet. It is something more subtle and, in many ways, more dangerous: a slow bleed. Prices in key metro areas are softening. Inventory is piling up at a rate not seen since the previous financial crisis. And the buyers who were once willing to pay any price to get into Texas are suddenly hesitating, recalculating, and in many cases, walking away from deals entirely. But there is a specific financial mechanism accelerating this correction that most analysts are not discussing publicly. It involves a hidden tax that is effectively adding $500 to $800 per month to the cost of owning a Texas home, making it less affordable than many of the state's people fled. I'll break down exactly how this works in the next section. The invincibility myth. To understand what is happening right now, we must first deconstruct the myth. The Texas growth story was real. It was fueled by genuine economic expansion: corporate relocations from Toyota to Tesla, a booming energy sector, and a population surge that added millions of residents over the past decade. But somewhere along the way, the market stopped pricing based on fundamentals and started pricing based on momentum. You might think that strong job growth automatically supports high home prices. But the reality is far more nuanced. Job growth supports sustainable price growth only when wages keep pace with asset appreciation. In Texas, they did not. We are seeing a massive divergence between the median home price and the median household income. This affordability gap has widened to levels that historically precede meaningful price corrections. During the previous housing crisis, the same affordability gap appeared in markets like Las Vegas and Phoenix before prices collapsed by 40% or more. Texas didn't experience that correction because it didn't participate in the speculative excess of that era. But in the current cycle, Texas is the speculative excess. The same overbuilding, overleveraging, and over-optimism that defined the 2005 Sun Belt is now defining the 2020s Texas market. Stop and consider this: Texas currently has more homes under construction than any other state in the nation. More than California, which has nearly double the population. That statistic alone should make you pause. The oversupply crisis. This brings us to the first and most critical pressure point: supply. Texas is drowning in new inventory. During the peak of the migration boom, builders broke ground on tens of thousands of new homes across the state, particularly in the metros of Austin, Dallas-Fort Worth, Houston, and San Antonio. They were building for a future that assumed 200,000 new residents per year, indefinitely. But net domestic migration into Texas has slowed dramatically from its pandemic-era highs. The result is a classic supply overshoot. The homes are being completed and delivered into a market where the buyer pool has contracted. We are seeing active listings surge across every major Texas metro. In some submarkets, the months of supply, the key metric that determines whether sellers or buyers hold a leverage, has climbed above 6 months, which traditionally signals a buyer's market. But here is the insight that separates the amateurs from the professionals: not all of this inventory is visible on the MLS. There is a shadow inventory of completed but unlisted homes that builders are holding off-market, waiting for conditions to improve. When these units finally hit the market, and the supply shock could accelerate the price correction significantly. I'll explain where this shadow inventory is concentrated later in this report. Builders are now competing aggressively for a shrinking pool of buyers. We are seeing incentive packages that include interest rate buydowns, free upgrades, and closing cost credits worth $30,000 to $50,000. These incentives effectively reduce the price of the home without showing up as a price cut in the headline data. This is important because it means the real market correction is deeper than the published statistics suggest. For existing homeowners trying to sell, this builder competition is devastating. They cannot offer rate buydowns or $50,000 in free upgrades. They are forced to compete on price alone, and in many cases, they are losing to the new construction down the street. This dynamic is creating a two-tier market where resale homes are stagnating while builders move volume through financial engineering. Now that you understand the supply side of the equation, you must see the demand-side shock that is compounding the problem. The next section will reveal the hidden tax I mentioned earlier, the factor that is making Texas homeownership far more expensive than the headlines suggest, and why it is causing buyers to reconsider the entire value proposition of moving to the state. If the oversupply crisis is the weight pressing down on prices, the next factor is the chain pulling demand out of the market entirely. This is the hidden tax I mentioned earlier, and it is the single most misunderstood aspect of Texas homeownership. It is the reason why the no state income tax narrative is collapsing under mathematical scrutiny. The hidden tax: property taxes and insurance. Texas has no state income tax. This is the headline that launched 1,000 U-Haul reservations. But here is something most relocators don't discover until they receive their first escrow analysis. Texas has one of the highest effective property tax rates in the nation. You might think that no income tax means lower overall taxation. But the reality is the opposite for homeowners. In many Texas counties, the effective property tax rate hovers between 2% and 3% of the assessed value. On a $400,000 home, that translates to $8,000 to $12,000 per year in property taxes alone. Compare that to Florida, which has no income tax and lower property taxes, or Tennessee, which caps its property tax burden well below the Texas average. Here is a number that should stop every prospective Texas buyer in their tracks when you combine property taxes and homeowners insurance. The average monthly non-mortgage housing cost in Texas now exceeds $1,200 per month. That is more than the entire monthly rent payment in many Midwestern cities. But the property tax is only half of the equation. Insurance premiums in Texas have surged dramatically in the current cycle, driven by a combination of severe weather events, hailstorms, tornadoes, and flooding, and a litigation environment that has made Texas one of the most expensive states to insure a home. We are seeing annual insurance premiums jump from $2,500 to $5,000 or even $7,000 for standard coverage. In hail-prone areas like the Dallas-Fort Worth Metroplex, some homeowners are seeing premium increases of 40% to 60% in a single renewal cycle. This is not a temporary spike, it is a structural repricing of climate risk. Now, this is what I was hinting at earlier when I mentioned the factor making Texas less affordable than the states people fled. When you add a $1,000 monthly mortgage payment to $600 in property taxes and $400 in insurance, the all-in monthly cost of owning a $350,000 Texas home is nearly identical to owning a $500,000 home in a state with lower property taxes and cheaper insurance. The bargain evaporates. The demand destruction. This all-in cost reality is causing what economists call demand destruction. Buyers are running the full monthly payment calculations, not just the mortgage, and discovering that Texas homeownership at current price levels is no longer the value proposition it was marketed as. We are seeing a measurable decline in mortgage applications across the state. First-time buyers, who represent the largest segment of the market, are particularly affected. They are already stretched by student loan payments and high interest rates. Adding $1,200 per month in taxes and insurance on top of a $2,000 mortgage payment pushes them beyond their qualifying ratios. This demand destruction is most visible in the entry-level and mid-tier segments. The $250,000 to $450,000 range, which is the bread and butter of the Texas market, is where listings are accumulating fastest and where price cuts are most aggressive. Consider this. In the previous cycle, a home listed in suburban Dallas at $350,000 would receive multiple offers within 48 hours. Today, that same home sits for 60 to 90 days and often sells below asking. The market hasn't just cooled, it has frozen at the middle. Metro-level breakdown. The correction is not uniform across Texas. Let me walk you through the specific metros where the data is most alarming. Austin remains the epicenter of the Texas correction. The city that was once crowned the new Silicon Valley has experienced one of the sharpest reversals in the nation. We are seeing year-over-year price declines in the double digits in certain neighborhoods. The tech layoffs that gutted the high-income renter and buyer base have left behind a massive surplus of luxury inventory that nobody can afford. Dallas-Fort Worth is experiencing a different kind of pain. The oversupply here is concentrated in the suburban build-out zones Frisco, McKinney, Salina, where developers went on a building spree. These communities are now competing with each other in a race to the bottom on pricing. We are seeing builders offer 8 to 10 weeks of free mortgage payments just to move inventory. San Antonio has been hit by the military base realignment and a cooling in the local service economy. Prices here never surged as dramatically as Austin or Dallas, but the correction is notable because of the thin margin of equity most owners hold. Houston is the wild card. The energy sector provides a buffer, but the city's chronic flooding risk and insurance costs are creating a ceiling on appreciation. Certain flood-prone neighborhoods are seeing significant price declines as buyers avoid areas without adequate drainage infrastructure. Now that you understand how the hidden tax and metro-level dynamics are eroding demand, you must see the investor side of this crisis. The next section will reveal the rental yield compression that is crushing cash flow for landlords across the state, and why the institutional investors who fueled the boom are now quietly heading for the exits. If the demand destruction is freezing the retail buyer, the next pressure point is crushing the investor. For years, Texas was the #1 destination for rental property investment. The thesis was simple: buy a home with cheap debt, rent it to one of the thousands of newcomers arriving every week, and generate passive cash flow while the asset appreciates. It was a strategy that worked beautifully until it didn't. The rental yield compression. In the current cycle, rental yields across Texas are compressing at a rate that is alarming even the most seasoned landlords. The math is straightforward when you buy an asset at an inflated price, and your operating costs, taxes, insurance, maintenance surge while rents flatten, your net operating income (NOI) collapses. Here is a number that should concern every Texas landlord. The average gross rental yield on a single-family home in Austin has dropped below 4%. When you subtract operating expenses, property management, vacancy reserves, maintenance, taxes, and insurance, the net yield in many cases is approaching zero or turning negative. You are effectively paying someone to live in your property. This isn't isolated to Austin. We are seeing yield compression across Dallas, San Antonio, and the Houston suburbs. The root cause is the oversupply we discussed earlier. When thousands of new apartments and build-to-rent communities come online simultaneously, they flood the rental market with competing units. Landlords of existing single-family rentals are forced to cut rents to remain competitive. But their fixed costs, mortgage, taxes, insurance, don't decrease. The result is a cash flow crisis. Investors who bought at the peak, assuming 5% annual rent growth, are now seeing rents flat or declining. Their pro formas are broken. They are subsidizing their tenants' housing every month out of their personal savings. But here is the insight I promised earlier about the shadow inventory. This cash flow crisis is about to trigger a wave of investor selling that will add even more supply to an already saturated market. I'll reveal the specific data on this in a moment. But first, you need to understand who is selling and why. The institutional exit. During the pandemic boom, institutional investors, hedge funds, private equity firms, and publicly traded REITs bought tens of thousands of single-family homes across Texas. They were the smart money. They deployed billions of dollars with the thesis that Texas would experience perpetual population growth and rent appreciation. You might think that institutional investors have the financial staying power to weather any downturn. But the reality is more nuanced. These firms operate on strict return thresholds. When a portfolio fails to meet its target internal rate of return (IRR), the fund managers face pressure from their limited partners to liquidate underperforming assets and redeploy capital elsewhere. Stop and think about this. When a $500 million fund decides to exit a market, it does not list homes one at a time on Zillow. It executes block sales, dumping entire portfolios of 200 to 500 homes at steep discounts to other institutional buyers or liquidators. These transactions don't always show up in public MLS data, but they absolutely drag down comparable values in the surrounding neighborhoods. We are seeing early indicators of this institutional rotation. Several major build-to-rent operators have paused new acquisitions in Texas. Others are quietly marketing portfolios for sale through private channels. The signal is unmistakable. The smart money is no longer convinced that the Texas growth story justifies current valuations. For the individual investor, this institutional exit is a double threat. First, it adds supply to an oversaturated market, pushing prices down. Second, it removes a major source of demand. Institutional buyers were competing for the same properties retail investors wanted. When they leave the table, competition decreases, and so does pricing power. Now, this is the shadow inventory reveal I promised earlier. In addition to the institutional portfolios being quietly marketed, there are thousands of completed new construction homes that builders have chosen not to list yet. They are waiting for the market to stabilize. But stabilization isn't coming. When these homes finally hit the MLS and the institutional portfolios go to liquidation, we could see a supply shock in certain Texas submarkets that pushes inventory to 8 or even 10 months of supply. For reference, anything above 6 months is classified as a buyer's market. 10 months is a crash. The flip market collapse. There is one more investor segment that is accelerating the correction: the flippers. During the boom, Texas was a paradise for fix and flip operations. Investors could buy a distressed property, renovate it in 90 days, and sell it for a $60,000 to $100,000 profit. Today, that model is broken. Flippers are caught in a margin squeeze. Renovation costs have surged due to labor shortages and material inflation. Meanwhile, the after-repair value ARV is declining because the resale market is softening. We are seeing completed flips sit on the market for months, with the investor paying interest on their hard money loan while the property generates zero income. Many are selling at break-even or at a loss just to stop the carrying cost hemorrhage. This flip inventory is adding more supply to an already flooded market, creating a vicious cycle of downward pressure on prices. Now that you understand how investors, both institutional and individual, are exiting, you must see how all of these forces converge to create the final, most impactful shift. The next section will break down the buyer psychology shift, the specific metro areas where the correction is deepest, and most importantly, the strategic playbook for navigating this market, whether you are buying, selling, or holding. The supply is flooding. The investors are exiting. The hidden tax is destroying affordability. But there is one final force that ties everything together and determines the speed and severity of the correction: buyer psychology. And in Texas, that psychology has undergone a fundamental transformation. The psychology shift. During the boom, Texas buyers operated with a scarcity mindset. They believed that if they didn't buy today, they would be priced out tomorrow. This fear drove irrational behavior: waiving inspections, offering $50,000 over asking, and making decisions in 24 hours that should take 30 days. Here is something that has completely reversed in the previous cycle. The average Texas home received its first offer within 5 days of listing. Today, in many submarkets, the average is 45 to 60 days. That is not a cooling, that is a psychological regime change. Buyers have shifted from FOMO, fear of missing out, to FOOP, fear of overpaying. They are sitting on the sidelines, watching inventory pile up, and waiting for prices to drop further. Every week that passes without a sale reinforces their patience. Every price cut they see on Zillow validates their decision to wait. This creates a dangerous feedback loop for sellers. The longer homes sit, the more buyers hesitate. The more buyers hesitate, the longer homes sit. Eventually, sellers capitulate and slash prices. But by then, the buyers who are waiting often wait even longer, expecting further discounts. This is the classic deflationary spiral in real estate. You might think that a rate cut from the Federal Reserve would restart demand. But the reality is more complex. Even if rates drop by a full percentage point, the all-in cost of Texas homeownership, including the property taxes and insurance we discussed, remains prohibitive for a large segment of the buyer pool. Rate cuts alone cannot fix a structural affordability problem. This is exactly what I was alluding to when I mentioned the invincibility myth at the beginning. Texas is learning the same lesson that every boom market eventually learns: momentum is not a fundamental. When the narrative shifts, the correction follows. And right now, the narrative has shifted decisively. The strategic metro outlook. Let me give you a city-by-city assessment of where we stand. Austin: the correction here is the deepest and the most advanced. Austin overbuilt, overhyped, and overleveraged during the boom. The tech sector contraction has removed the high-income buyer. We are in the capitulation phase. Expect continued price declines until the inventory normalizes, which could take 12 to 24 months. Dallas-Fort Worth, the correction is concentrated in the northern suburbs where builders flooded the market. Core urban neighborhoods are holding up better due to limited supply. The two-tier market is pronounced here. Investors should avoid the new construction zones and focus on established neighborhoods with scarcity value. Houston, the energy sector provides a partial buffer, but flood risk and insurance costs are creating pockets of severe decline. Neighborhoods without adequate drainage infrastructure are essentially stranded assets. Buyers should demand flood history data and insurance quotes before making any offer. San Antonio, this market is experiencing a quieter, more gradual softening. The military presence and healthcare sector provide stability, but the entry-level segment is oversupplied. The correction here is likely to be shallow but prolonged. The strategic playbook. So, what should you actually do with this information? For buyers, this is your window of maximum leverage. Do not rush. The inventory is rising, and seller psychology is shifting in your favor. Make offers 10% to 15% below asking, and include contingencies. Insist on full inspections. Get insurance quotes before you make an offer, not after. The all-in monthly cost is the only number that matters. If it doesn't work today, don't underwrite future rate cuts or appreciation to make it work. Here is a negotiation strategy that is working right now. Ask sellers to buy down your interest rate for 2 years instead of reducing the purchase price. This preserves the comparable sales value for the neighborhood while lowering your monthly payment. Builders are already doing this aggressively. Individual sellers should be open to it as well. For sellers, the days of aspirational pricing are finished. If you need to sell within the next 12 months, price at or slightly below the most recent comparable sale. Do not wait for the spring market to improve conditions. Every month of additional inventory makes your position weaker. A stale listing is a dead listing. For investors, stop buying for appreciation. The growth story is on pause. Underwrite every deal for cash flow at current rents, with conservative assumptions for vacancy 8 to 10%, maintenance 10%, and rising insurance costs. If the deal doesn't cash flow on day one with those buffers, pass. There will be better opportunities as the correction deepens. The verdict: Texas is not collapsing. It is correcting. And corrections, while painful, are healthy. They flush out speculation, reset valuations to sustainable levels, and create opportunities for disciplined capital. The state's long-term fundamentals, job diversity, population base, and business environment remain intact. But the short-term pain is real, and it is hitting hardest in the markets and segments that were most inflated. The question is no longer are prices dropping, the question is how far will they drop, and how long will it take? The answer depends on your specific metro, your specific neighborhood, and your specific price tier. If you found this analysis valuable and want to track the specific zip codes where inventory is accumulating fastest, make sure you are subscribed.